Imagine a place where billions of dollars can disappear in a single day. A place where one phone call can create a billionaire or bankrupt thousands of ordinary people. A place where power isn't measured by armies or governments, but by money. Welcome to Wall Street. For over 200 years, this small street in New York has been the beating heart of the global financial system. It has financed some of the world's greatest companies, created unimaginable fortunes, and helped shape the modern economy. But behind the luxury offices and expensive suits lies another story, a story of greed, manipulation, insider deals, and financial disasters that have changed millions of lives. This is the dark side of Wall Street, a street that changed history. It's hard to believe that Wall Street was once just a dirt road. Back in the 1600s, Dutch settlers built a wooden wall to protect their colony. The wall eventually disappeared, but its name lived on. Everything changed in 1792 when 24 stockbrokers signed the Buttonwood Agreement, creating America's first organized stock market. At first, Wall Street had a simple purpose: to help businesses raise money and allow investors to share in their success. As America grew, so did Wall Street. Railroads, steel companies, oil businesses, and banks all depended on investors. Soon, Wall Street became the financial engine of the United States. With every successful company came bigger fortunes. And with bigger fortunes came bigger temptations. When greed took control, the stock market rewards smart decisions. But some people wanted shortcuts. Instead of earning money honestly, they began manipulating stock prices. Groups of wealthy investors secretly bought large amounts of a company's stock, driving up the price. As ordinary people rushed to buy, believing the company was booming, those same investors quietly sold their shares at huge profits. Everyone else was left with worthless investments. It became clear that on Wall Street, information could be worth far more than money itself. Those with inside knowledge often had an advantage that ordinary investors could never match. This practice became known as insider trading. Imagine knowing tomorrow's headlines today. If you knew a company's profits before the public, you could buy its stock before prices rose. If you knew a business was about to fail, you could sell before everyone else. For years, some people used confidential information to make millions while ordinary investors unknowingly played a game they couldn't possibly win. The culture of excess. By the 1980s, Wall Street had transformed into a symbol of wealth. Young graduates dreamed of working there, not because they loved finance, but because the rewards were enormous. Million-dollar bonuses became common. Luxury apartments, sports cars, private jets, and extravagant parties became symbols of success. Competition was ruthless. Traders worked incredibly long hours under constant pressure. Every decision involved millions of dollars, and every mistake could destroy a career overnight. Many believed one simple rule: winning was everything. The desire to earn more money pushed some firms to take bigger risks than ever before. It was a dangerous game. And, eventually, the market pushed back. Black Monday. On October 19, 1987, panic spread across Wall Street. Selling triggered more selling. Computers automatically placed even more sell orders. Fear spread faster than anyone expected. By the end of the day, the Dow Jones Industrial Average had fallen more than 22%, the biggest single-day percentage drop in its history. Billions of dollars vanished in just a few hours. No war had begun. No natural disaster had struck. The market simply collapsed under the weight of fear. It was a warning that modern financial markets had become so connected that panic alone could crash the entire system. Although the economy eventually recovered, Wall Street had learned a painful lesson. Speed and technology could make fortunes overnight. They could also destroy them just as quickly. Selling dreams. After the crash, Wall Street continued to grow. Banks created new financial products that promised higher returns. Brokers earned huge commissions by selling investments to ordinary families. Many financial professionals acted honestly, but some were more interested in profits than people. Risky investments were often sold as safe opportunities. Clients trusted the experts. The experts often trusted the bonuses. As long as the money kept flowing, few people asked difficult questions. It seemed like the financial system had become unstoppable. But beneath the surface, another crisis was quietly taking shape: the perfect illusion. In the early 2000s, banks discovered an incredibly profitable business: home loans. Millions of people borrowed money to buy houses. Banks then bundled thousands of these mortgages together and sold them as investments to institutions around the world. Everyone believed housing prices would continue rising forever. Banks made billions. Investors earned impressive returns. Homeowners believed they were becoming wealthier every year. On the surface, everything looked perfect. But there was one serious problem. Many of these loans had been given to people who couldn't afford to repay them. Instead of reducing the risk, Wall Street simply packaged it into complicated financial products and sold it to someone else. The danger didn't disappear. It was hidden. For years, profits continued to rise while warning signs were ignored. The financial system looked stronger than ever. In reality, it was becoming more fragile every single day. Then, in 2008, the illusion finally collapsed. Banks failed. Markets crashed. Millions of people lost their jobs, homes, and life savings. The disaster would become the biggest financial crisis since the Great Depression. And it would expose the darkest chapter in Wall Street's history. The house of cards falls. For years, Wall Street looked unstoppable. Banks were making record profits. Investors believed the economy would keep growing. Housing prices seemed to rise every month. Almost everyone thought the good times would last forever. But underneath all that success was a dangerous truth. Millions of home loans had been given to people who couldn't afford them. As long as home prices kept rising, the system worked. But when housing prices began to fall in 2007, everything changed. Homeowners started missing their mortgage payments. Banks suddenly realized that many of the investments they owned were worth far less than they had believed. The foundation of the financial system was beginning to crack. The collapse of a giant. Then came September 15, 2008. One of America's oldest investment banks, Lehman Brothers, filed for bankruptcy. It wasn't just another company failing. It was a symbol of Wall Street itself. The news sent shockwaves across the world. Stock markets crashed. Investors panicked. Banks stopped trusting one another. Companies struggled to borrow money. The global financial system came dangerously close to freezing. Within days, fear spread from New York to London, Tokyo, Mumbai, and nearly every major financial center. The crisis had become global. The price paid by ordinary people. The people who suffered the most weren't the bankers. They were ordinary families. Millions lost their jobs. Many homeowners were forced to leave their houses after they could no longer make mortgage payments. Businesses closed. Retirement savings disappeared almost overnight. For countless people, years of hard work vanished because of decisions made in boardrooms they would never see. Public anger exploded. People asked a simple question: how could this happen? Many believed Wall Street had taken enormous risks while ordinary taxpayers were left to deal with the consequences. Too big to fail. As panic spread, governments faced an impossible choice. If major banks collapsed, the entire economy could fall with them. So governments stepped in with massive rescue packages. Billions of dollars were used to stabilize the financial system. Supporters argued that these bailouts prevented another Great Depression. Critics saw them differently. They believed Wall Street had privatized its profits but socialized its losses. When times were good, executives earned enormous bonuses. When things went wrong, taxpayers helped rescue the system. The phrase, "too big to fail," became one of the most controversial ideas in modern finance. A new Wall Street. After the crisis, governments introduced stricter financial regulations. Banks were required to hold more capital. Risk management improved. Regulators increased oversight. But Wall Street didn't stop evolving. Instead of crowded trading floors filled with shouting brokers, computers now execute many trades in fractions of a second. Algorithms buy and sell stocks faster than any human ever could. Artificial intelligence is beginning to influence investment decisions. Technology has made markets more efficient. But it has also created new risks that experts are still trying to understand. The face of Wall Street has changed. Its influence has not. The lessons history keeps teaching. The history of Wall Street isn't just a story about money. It's a story about human nature. Greed, fear, hope, confidence, panic. These emotions have driven every major financial boom and every devastating crash. Markets don't collapse simply because numbers change. They collapse because people do. History shows that whenever investors believe prices can only go up, someone eventually pays the price. Is Wall Street really evil? So, is Wall Street the villain? Not exactly. Without Wall Street, many of the world's biggest companies might never have received the funding they needed to grow. Businesses create jobs. Innovation requires investment. Economic growth depends on capital. Wall Street has helped build industries that transformed the world. The problem isn't the market itself. The problem begins when greed replaces responsibility, when profits become more important than people, when short-term rewards outweigh long-term consequences. Most people working in finance are honest professionals, but history has shown that when incentives encourage excessive risk, the damage can spread far beyond Wall Street. Final thoughts. Today, Wall Street remains one of the most powerful financial centers on Earth. Every day, trillions of dollars move through its markets. Its decisions influence pensions, businesses, governments, and ordinary families around the world. Its story is filled with remarkable innovation, but it is also filled with painful lessons. The greatest danger has never been technology, or money, or even the stock market itself. It has always been the belief that greed has no limits and that success can continue forever without consequences. Because every financial bubble eventually bursts. Every boom eventually faces a test. And history has a way of reminding us that no market, no company, and no fortune is ever truly untouchable. Wall Street can create incredible wealth. But if history has taught us anything, it's that the strongest investment isn't blind optimism. It's wisdom, patience, and knowing that when everyone believes they can't lose, that's often when the greatest risks begin. Don't forget to like, subscribe, and write your lovely comments about the story. See you later with another interesting story. Till then, bye-bye.